There is no doubt whatsoever that we are in a full-fledged bear market. The definition of a bear market is a decline of more than 20% in a major index. Not only is the S&P 500 down over 20%, but all four major indexes are down over 20%. The NASDAQ 100 is down 34%. NerdWallet defines a bear market as this: while 20% is the threshold, bear markets often plummet much deeper than that over a sustained period, not all at once. Although the market has a few occasional relief rallies, the general trend is downward. Hi, I'm Ben Reppond. Today is October 18th, 2022. Welcome to my YouTube broadcast. I've shown this chart before. It helps give us context for looking at bear markets. And today's video, I want to feature the lessons that we can learn from bear markets. So it'll be helpful to look at this because this gives us a 150-year view of the S&P 500. And the chart is logarithmic and it is adjusted for inflation. In the chart, it's a graph, it's a line, goes up and down, and it is the S&P 500 actual, and prior to the S&P 500 being around, it's a simulation of what it would have been like, taking us all the way back to 1871. In that line, you can see there are blue portions and there are red portions. The red portions define bear markets. Bull markets, up markets, are defined by the blue portion of the line. In this 150-year history, there were four major bear markets. There were five major bull markets because the bookends are bull markets. And you can see the way they go. There's interesting patterns that you can see here. And this Russell Napier, financial historian, said that the length of a secular long-term bear market, and actually bull market as well, is 10 to 15 years. And so anything that happens when we're actually in a bear market, a long-term bear market, anything that happens in that 10 to 15 year period of time, both up and down, are still part of that downtrend, that bear market that goes for that usually 10 to 15 year period of time. The Great Depression was one of those secular bear markets. It actually lasted 20 years, so that would be the exception. But the others were 10 to 15 or 9 to 15, however you measure it. I show this because I want to point out that at the very end of the chart, the very far right of the chart, is a tick down. I believe that we are entering or have entered a new secular long-term bear market. Now, we don't know that for sure yet because we will know that in retrospect. When we look back at it, we will see that that in fact was the case. But right now, here's why I believe that. The tick down, it doesn't show very dramatic because, again, it's exponential and adjusted for inflation. But it is a bear market. So it's either part of it's a correction, which means a cyclical, a short-term bear market inside of the longer-term bull market that began in 2009, or it's the beginning of a new long-term trend down called a secular bear market. It's one of those two things. And it looks like, it feels like the magnitude of it, the future that we look into from today looks and feels like it is going to develop into a long-term, meaning a 10 to 15 year bear market. Now, as I read earlier, when that happens, it is not a straight, it doesn't go straight down, it goes up and down. And I point this out because you can see in these other charts or in these other periods where that happens. And this is, keep in mind, this is a 150-year chart. Other than the Great Depression, which is the second red line, the rest of them are 10 to 15 years. So you can see in all of them that they have these periods that go up, and it looks like and probably feels like we're done. We're done with this bear market. Now we can go on to making money again. And we're now entering a new bull market. And it feels like that because these can go up for several weeks, several months, even a few years. But they eventually collapse and go all the way back down until they are exhausted. Now, one of the reasons why I think that we are in a long-term bear market is there is so much excess in the system. When I say excess, I mean there is excess printed money. We got $8 to $9 trillion of printed money with nothing behind it. That's excess. We have debt, 31 trillion plus. 31 trillion with no concept, no plan to repay $1 or no plan to repay any interest. Wouldn't it be interesting if we had somebody run for office, for president or for Congress or Senate, that would run on the platform that they were actually going to start reducing the debt? When's the last time you ever heard that? I don't remember hearing that. If somebody ran on that platform of reducing the debt, I think they'd be laughed at because that's going to go nowhere. It's not even a reality. But that's how far we've gone, is that we're in this spending mode of trillions and trillions of dollars. Just spend it. Let's pander for votes, give out goodies, whatever a person's bent is, and no plan to pay it back. And so that has got to get worked out of the system. Now, that's a big problem. It's a multi-trillion-dollar problem. So I don't know how that's going to get dealt with, but to just keep on going and piling up debt as far as the eye can see and piling up interest on top of debt, it's not sustainable. So what is the end game and how does this get resolved? I do not know. But I do know that the printed money and the debt are the two things that I see that are excess in the system. When I went back and looked at all of these four major bear markets and studied them, in every case, debt and printed money or printed money were part of, or a major part of, every one of them. The third one, this one in the late 60s and 70s, had another element of high inflation and high energy prices. But they all had this component of too much spending, too much debt, and in most cases, too much printed money. So that's got to get worked out of the system. So yeah, I do believe that we're in a new long-term bear market. And as you can see, there are times where it can literally go for a year or more in an upward direction. And so there's opportunity to make money on the upside in this bear market. It's not today. Today we're in a preservation mode of sitting in cash, waiting for this to work out. But there will come a time in this bear market where we will enter the market and with the goal that we are going to make money. And we'll do that until we get the indication that we're no longer in an up market, and then we'll get back out again. But that's how we do it. But this is a cycle, and I think it is going to, I shouldn't say wash out, but it will be a wake-up call for the traditional portfolio, the traditional financial advisor, who is just a buy and hold financial advisor, doing, buy and hold portfolios. And because what's so different about this market this time is that bonds, government bonds, corporate bonds, high yield, high quality, they're all correlated with equities. So as equities go down, so are bonds, and of course interest rates are going up. So I think that's going to present for this next 10 to 15 year period of time, going to present a very big challenge for investors, financial advisors, and traditional portfolios. This is, I take that 150-year chart, and I took a section of it. I took a 2-year period, 73, 74, which was part of one of the bear markets, to show you some components of this. This just was a chart that I got on the internet. I thought it was, representative of a bear market. So you can see that it goes down and then it tries to go back up, or maybe traders push it up. It goes down, it goes up, but the long-term trend is down until it gets exhausted. Now this didn't actually, this is 73, 74. It did go up following 74, but only for a while, because 79 to 81, 82, that's when it finally ended. And so it went up temporarily at the end of this, but it wasn't done. I put an arrow here. I just kind of superimpose this and saying, if I were to say, where are we today in the stock market? Where are we in this cycle, assuming we're in a long-term secular bear market? I would say we are about where the blue arrow is, roughly. That's an opinion. So in other words, we've got more up from here, and we have a lot more down from here. That's the opinion of a lot of people. This is another example of this, and this is the S&P 500. This takes the internet bubble bursting 2000 all the way through the housing crisis of 2007 to 2009. Both were part of a longer-term bear market. So what happened is interesting to see. So you can see that collapse at the beginning, 2000 all the way down to March of 2003, marked by the first red arrow. And the second red arrow is the 2007 to 2009 crisis, kind of compressed. And then you can see the period of time in between, the blue line in between those two red arrows, and that was a cyclical bull market. And people were relaxed. Okay, we're back to making money. This is going to go back to the moon. And complacency set in. And then, of course, it got slammed again. All 9 years were part of that long-term secular bear market. I put a little black circle there at the beginning of the first one to say, if I were to superimpose today into this chart, I'd say that's about where we are. If this is what our long-term secular bear market looks like, then that's about where we are in the time frame. I want to play 3 brief clips for you. I'm going to shift now. I want to make this clear. I'm shifting from the stock market, the bear market, over to the economy. And there are a lot of people who are saying we are headed into a recession. And all of these are about the recession. These are all credible people. First, I'm going to play a clip from Jamie Dimon, the CEO of JP Morgan, and next from Mohamed El-Erian, and then finally from the chief economist of the International Monetary Fund. They're just brief clips, but they will each make a point from their own perspective. They say it a little differently, but they're all saying, from their perspective, we're headed into a recession next year. Jamie Dimon points out the aspects of our economy that are positive. He recounts several things that are positive on both the individual, corporate, and government levels. Yet he stresses that obvious economic and geopolitical pressures are likely to push the U.S. and the rest of the world into a recession in 2023, and he points out, correctly so, that Europe is already in a recession. Here's this clip from Jamie Dimon.
So I think you got to put two things in mind here. Currently, right now, the U.S. economy is actually still doing well. Consumers have money, fiscal stimulus, they still have more than they had before. They're spending 10% more than last year, 35% more than pre-COVID. Their balance sheets are in great shape. Yes, debt's gone up a little bit, but not nearly to pre-COVID levels. And therefore, even if we go into recession, they're going to be in much better shape than 08 and 09. Companies are in good shape. Credit's very good. Markets are still open, though rocky and stuff like that. But you can't talk about the economy without talking about the stuff in the future. And this is serious stuff, okay? This is inflation, which obviously is changing the effect of those numbers I just told you about. It's rates going up more than people expected already, and probably a little bit more from here. It's QT, which we've never had before. So therefore, the unknown effects, and you see it today in bond markets around the world and sovereign markets and people selling U.S. Treasury debt, and it's the war. And these are very, very serious things, which I think are likely to push the U.S. And the world. I mean, Europe is already in a recession, and they're likely to put U.S. in some kind of recession 6-9 months from now.
Next, I want to play an interview, just a brief segment of an interview that Jonathan Ferro from Bloomberg does with Mohamed El-Erian. I like this because Mohamed El-Erian is probably, that I regard him very highly. He's very smart. He's a student of the markets. He has an international perspective, and his track record is very, very good. He calls it correctly. He's blunt. He's to the point, and he minces no words in what he intends to say. He uses in this clip a metaphor. It's a metaphor of a car slamming on the brakes to describe the actions of the Federal Reserve. As a result of slamming on the brakes, he says, in his blunt way, the whole financial system is going through the windshield. Now, remember I said earlier that we need to work out the excesses. And if this is correct, it may be correct. If this is correct, that is what it means to work the excesses out. Is that going to be painful? Very painful. But we cannot resume, we cannot get back into a new bull market, which is going to take us up for 10 plus years. We cannot get to that place until we do work the excesses out of the system, and we actually, as he says, the economy goes through the windshield. So here's this piece from Jonathan Ferro doing the interview with Dr. El-Erian.
Bob Michael at JP Morgan Asset Management has things to say, caught up with the team at Bloomberg. This is what he had to say. When the central bank steps on the brakes, something goes through the windshield. The cost of financing has gone up, and it will create tension in the system. Mohamed, you've been talking about this for a long, long time. What's coming through the windshield?
So the economy is starting to go through the windshield. The financial system is starting to go through the windshield. This is not stepping on the brakes. This is slamming the brakes. It is the most front-loaded interest rate cycle that we have seen in a very long time, and it didn't need to be this. This is the tragedy of it, John. It didn't need to be this way. This is a self-inflicted wound by central banks.
You're incredibly frustrated with this Fed and the damage it's about to do to this economy.
I am, not just to this economy, but to the rest of the world. And they've been warned over and over and over again, but somehow they held on to this transitory for way too long. Mistake number one. And mistake number two, when they retired that word from the vocabulary, they didn't act. They didn't act in any meaningful way.
I read this article on CNBC, and it caught my attention. The IMF, the International Monetary Fund, cuts global growth forecast for next year and warns the worst is yet to come. Now, there are a lot of people, maybe Dr. El-Erian and Jamie Dimon would say the worst is yet to come, but when the chief economist of the International Monetary Fund says that, based on the fact that they have cut their forecast, and what that means is they believe that some parts of the economy are going into contraction, and he says a third of the segments of the economy will go into contraction. That means negative growth. That means going backwards, however you want to say it. And anyway, so this is the chief economist, Pierre-Olivier Garancha, chief economist at the International Monetary Fund, on CNBC. And he says at the end of it, he uses very careful words, but he says at the end of it correctly, in 2023, we are going to feel some pain.
Just how bad is it really going to be, and how can we perhaps ease some of the downside pain?
Well, in our baseline projections, what we are seeing is the global economy slowing down from about 3.2% growth in 2022 to about 2.7% next year in 2023. So that's, the 2.7 is a downward revision from what we were expecting earlier. We're expecting 2.9, we're now expecting 2.7, so it's coming down. It's still positive, but when you look under the hood, what we found out is that about a third of the global economy is going to be experiencing a contraction, 2 consecutive quarters of negative growth. So there's going to be a lot of slowdown, a lot of economic pain going down in terms of what we'll see next year, and inflation will still be somewhat elevated. And so what we're seeing is, this battle to bring down inflation is underway. It's going to slow down growth. Inflation is gradually going to come down, but next year is going to feel painful.
Part of this, I've said this earlier, part of the problem with this year with portfolios, with investments, is that we not only have a declining stock market where most equities, the broad-based equities, are down 20 to 30%, probably an average is around 25%, but bonds are down a lot. Now, I'm going to show the long-term government bond. This is the ETF, TLT. There are intermediate-term bonds, IEF, and short-term bonds, SHY. And there are corporate bonds, there's high-yield bonds, various kinds of bonds, and they're all down, and some are down more than others, some less than others, but this is definitely used in portfolios quite a bit. And so I don't want to say this is true for every portfolio, but it's a benchmark certainly for the bonds that tend to do better in an up market. TLT, this 20-year government bond, is down. This is a chart from the beginning of the year. From the beginning of this year, this is down, this is from November 29 of last year. So it's down, it's about almost 11 months, is down 36%. If you go back to the summer of 2021, so this would be, I think it's 2020. The long-term loss is 42%. So it is still in decline. I don't know when it's going to resume its upward trajectory, but I think that probably has something to do with when interest rates stop going up, or the perception that they're going to stop going up. This is an interesting chart because it shows the amount of excess that has been in the system. and according to some, a lot of excess that's still in the system. One of the methods for valuing stocks is the price-earning ratio of stocks, or for that matter, the price-earnings ratio of an index. This chart plots the price-earnings ratio over time, going back to 2017, so this would be about 5+ years, and you can see the price-earnings ratio, and this excludes the high-tech stocks. So when you pull out the high-tech stocks out of there, and then you say, what really is, and these would be Apple, Amazon, Microsoft, Facebook, and Google, and when you pull those out of there, just those 5, this is what the price-earnings ratio looks like. So it was upward beyond 28 to 1 for this group. For the rest of the S&P 500, once those 5 are taken out, and it is now down to about 12 to 1. You see how much the tech stocks have held up the S&P 500, but when they're taken out of the picture, this might be a representation of the rest of the economy. Now I want to go over to inflation. This is the core inflation, CPI, Consumer Price Index, which they use to measure inflation. In the month of September, it was projected that there was going to be 0.4% increase. This is month over month. It came in at 0.6%. Now, if you don't really follow this, you may look at that and say, what's a big deal? 0.4%, 0.6. Well, that's just 1 month. So when you annualize that, that's quite an increase. And what they were expecting was that once you pull out food and energy, which is what the core CPI is, when you pull that out, that in the core index, they were expecting it was going to go down. It did not go down. So core inflation is still up at a nasty high level. And of course, when that information, when that news came out, it tanked the stock market. I mean, that was not a good day. So that's where we are. We still have a serious inflation problem. The Fed, according to Chairman Powell, is very committed to bringing it down, and I believe he will do that by the raising of interest rates, but he's apparently going to aggressively, or recommend that the Federal Reserve Board aggressively raise interest rates. And he knows, and he's now said it, he tried to avoid it for a long time, but he's now said it, that this is probably going to crash the economy, which is what I just played you from these other people. They're saying it's unavoidable because we've got to, and they've got to, get inflation down. That's not an option. So I think for the next year or so, we deal with a crashed economy. Now, how does that play out in this long-term bear market that I've been talking about? It's nasty. You know, it's not going to go straight down. You can see that in every one of the charts. It has all of these ups and downs that go with it. But from the economy standpoint, the inflation is a problem. It will come under control. That's the good news. Bad news is a crashed economy. And as Mohamed El-Erian says, the economy is going through the windshield. The yield on the 2-year government bond, I did not say 20, the 2-year government bond is 4.47%. And you can see where it came from. Well, what that means is, so you have to kind of translate this, what this means is that the short-term bond, the intermediate-term bond, and the long-term bond, they all move like this in varying degrees. They're all going up that much as far as yield because interest rates are going up and bond yields track interest rates. What that means is the bond prices and the bond fund prices are dropping. And I showed you that in that chart of TLT. But pretty dramatic of how much the yield has gone up, which is basically crashing the bonds themselves. A primary indicator of a recession is the yield, the difference between the yield of the 2-year bond and the 10-year bond. And it's called the yield curve. And normally investors are paid a premium and paid higher bond yields on the longer term maturities because they're taking more risk measured by time. When that changes and goes over to the highest yield, the best premium is being paid on the 2-year bond, the short-term treasuries. It says that there is risk in the market. Every time in the last 50 years that this has gone negative, it has been followed by a recession, and that's why it's such a primary indicator. Also, former Treasury Secretary Larry Summers has what I call the Larry Summers rule. That's the 4% rule, which is when unemployment drops below 4% and inflation is above 4%, for the last 50 years, a recession has followed. That's also been true. So here you've got all these experts I've shown you, and then these two major indicators, this being one of them, are all saying a recession is in front of us. And as I think it was Dr. El-Erian said, Europe is already in recession. So Europe is a mess. But this is coming to the U.S., and this is all based on U.S. Treasuries. Okay, the flow of funds report, this is where money is going for this past week. It actually has about a week lag to it. The conventional equity funds had an outflow of over $10 billion. Conventional bond funds, no surprise, had an outflow of $25 billion, and money market funds had inflows of $10 billion. And that's more, the money market number is a more updated number. Okay, to the dashboard. This is an unusual dashboard to see it all red. It was all red last week. So this is measuring the 6 major equity indexes and the bond index of 20-year government bond index. So going from best to worst, top to bottom, I will show you what they are. And the numbers are for that day. This would be Friday, last week, this past month, this past quarter, and this year to date. So a view from all of them. Everything is negative except the Dow Industrials for last week were actually positive. Everything else negative for every time period. And then to the right of those same indexes are because it's a red dot, are measured, where are they relative to their 20, 50, 100, and 200-day moving averages. Every one of them is below their all 4 of those moving averages. Very unusual. But just going down the list, you can see, and I'll just go name them quickly. The Dow Industrials down 18% year to date. This is the 5th column of numbers from the left. The S&P 500 down 24.7. The Russell 2000 small cap index down 25%. The emerging markets, the developed markets down 28. The emerging markets down 29, almost 30. And the long-term government bond, as I said earlier, down 33.4. And the NASDAQ 100 down 34% year to date. When we take the S&P 500 and break it apart into its component parts, the sectors that are within the S&P 500, we get to see what's going on inside of that number. If the S&P 500 is down 24%. That's an average of all of these indexes, and it's on a weighted average basis. The one at the top is above its moving average, all four moving averages, and that's energy, which is basically oil companies, XLE. From there, and that's positive 44% year to date. And you obviously know why. XLV, which is the healthcare, down 12, consumer staples down 12, industrials down 19, financials down 20, basic materials down 24, and all the way to the bottom, retail and telecommunications down 36 and 37%. Now I want to go through some charts with you. This is the S&P 500 over the past year. It goes up and down, but the general direction for the past 9 months or so is down. And you can see that there are times where it goes up, it wants to go up, and then it collapses. And remember, that's what I told you. That's the way bear markets work. They go down, the pressure is to go down, and then there's these periods where they need a little bit of relief, and they try to go back up, but it never lasts. The S&P 500 has growth stocks in it, and it has value stocks. Growth stocks are focused more on revenues. Value stocks are more focused on profit. And this is a 12-month chart, so over this 12-month period, this goes back about 11 months, you can see that growth has been out of favor. It's because it's the numerator in the equation. This is a line that plots the ratio, growth meaning numerator, value meaning denominator. So if it goes up, it means that growth is in favor. If it goes down, it means value is in favor. So you can see that the focus is primarily on companies that are profitable, as opposed to companies that are focused mostly on sales. For the past 24 months, this is measuring a 24-month period, this shows that the long-term direction of that small cap versus large cap. Small cap is mostly out of favor, meaning that it's going down, and then it's starting to come back into favor as evidenced by the red line at the end. But it's still, over the 24-month period, still mostly favoring large cap, meaning the S&P 500. This is a chart of long-term government bonds, so I told you this earlier. So this goes back over 2 years ago, back to the summer of 2000. Bonds, and this is the long-term bond, but bonds in general began to lose value in the summer of 2020. This one went down, it tried to go back up, and then eventually just collapsed again. The arrow at the right shows this is about 10 and a half months. You can see how much trajectory it has to the downside. Why? Because interest rates are going up and people and governments are dumping bonds. And that's evidence from both of those black lines. To contrast this with, same 30-month chart, with the intermediate term bond, or bond ETF, IEF, you can see that it also has a very sharp trajectory to the downside. It moves a little differently, but in a lot of ways similar. And then when you look at the short-term government bond, remember I told you about the yield is so high, exaggerated on the short-term bond, that it is higher yield, which means the bond itself has a higher loss. Look at that line. I mean, that is amazing. Would you want to own that as an investment? Would you want to own any of these? Yet most of you do own these. If you're in a target date fund in a 401k plan, believe me, you own some of these. If you're in a 60-40 portfolio or some kind of a buy and hold traditional portfolio, you own some of these or things like these. And you didn't sign up for it, you might think to yourself, why don't they get me out of this stuff? It's stop the bleeding. No, that's not what they believe in. But this is why so many people who I respect don't buy bonds. They don't believe in bonds. Warren Buffett says, I wouldn't buy a 2-day bond if one existed. And Stanley Druckenmiller, you look at the best performing endowment funds in America, the Notre Dame and Yale. I believe I found it correctly that neither one of them own bonds. They own some tips, but they do not own bonds. They believe more in equities. And yet they have, if you measure Yale and Notre Dame for the last 30, 35 years, they have the highest rate of return of any major institution in America. And you look at these, Stanley Druckenmiller, Ray Dalio, I mean, you go on and on with these, Michael Burry, all of these people, you say, these are smart people. Why don't they own bonds? Because they're a bad investment. And when it turns around and they go up, they put a drag on rate of return. So that's, each one could answer it for themselves. I'm just telling you what I observe. Okay, gold, measured by GLD. This is a 48-month chart, so you can see over 2 years the trajectory of gold, measured by the ETF GLD, is in a downward direction. Silver, same thing, even more of a downward direction. And when the two are contrasted with each other in a ratio, gold being the denominator, silver being the numerator, you can see that the trajectory favors gold. It is down less, but both of them are down. The volatility index, no surprise here, is up around 32, and the line I put on there at 24, which I believe is an indication of where risk is higher when the line is above, when the volatility index is above that line, and is lower when it's below that line. That's just my measurement. The Asbury 6, Asbury Research does these metrics, and this is showing all 6 of their metrics. They've been negative for some time, and they were still negative, no surprise, as of Friday. This is their cross-asset relative performance chart comparing one asset to another or one ETF in that asset to another. So it's a generalized relative performance indicator, but I wouldn't take it beyond that. Which one is doing better? Low volatility stocks or high volatility? Low volatility is better. Which one's better, the Dow Industrials or the S&P 500? We saw from a previous dashboard that the Dow is better, and here it shows that also, better for all 3 weekly, monthly, and quarterly views. And then the S&P 500 compared to the NASDAQ, again, from the previous dashboard, you can see that the S&P 500 is down less. Outperform would be an incorrect word. It's down less than the NASDAQ. And value or growth, we saw that in the chart. SPY V and SPY G, you could see the degree to which value is outperforming growth, and it's in favor here. And then the U.S. versus emerging markets, they're both down and down a lot, but the U.S. is down less. In bonds, government is down less than corporate bonds. High yield is down less than corporate bonds, and short term is down less than long term. We measure the U.S. versus the world. The U.S. still is not making a showing here. The U.S. is we could go into all kind of reasons why, but this just is an output chart comparing SPY, the S&P 500, to the ETF for each of these countries listed in the second column. The ones that have outperformed the most are Italy, Switzerland, France, Eurozone, and Russia. Kind of somewhat of a similar pattern there. The Buffett indicator is fairly valued. It is the ratio has come down. It is not undervalued yet, but it is fairly valued as of Friday. And that ratio of the stock market divided by the GDP, the economy, is 151%. Still high, but the label is fairly valued. Gold and silver. Both, you saw from the previous chart, both had negative weeks. Gold was down 3.1, silver down 9.2. That's quite a bit for that week. This is a depiction of a young man who's called the Good Boy. It was developed in 1894. And it went on to become a symbol or an image that was used in 1908 for a dentist or dentistry that was called pain-free dentistry. Seems like an oxymoron to me. But this was their image that they used in their advertising. It later surfaced in the 1950s. In 1954, surfaced under the name of Alfred E. Neumann. And in 1956, the end of 56, so this would be 30 months, this is the 30th edition of Mad Magazine, December of 1956. So some of those years, they would put him on the cover. And then in the 1960s, there was this kind of a movement to jokingly run Alfred E. Neumann for president. And there were buttons, Alfred E. Neumann for president. Both, this was in the 1960 campaign of Kennedy and Nixon, and in the 1964 campaign of, let's see, 64 was Johnson and Goldwater. And so this was run as a joke. And I think a lot of people wrote in the name Alfred E. Neumann for president, on their ballot, being maybe not so fond of the choices they had. But I thought about it, and the reason I'm showing it to you is that it seemed that if we were to take this theme, what? Me worry? That would be a good slogan for the financial industry and for portfolios for investors, for financial advisors in December of 2021. There's nothing to worry about. This thing is going to keep on going, and if it does go down, not to worry. Bonds are going to counter stocks, which they always have, mostly for the last 40 years. And so I'm not going to worry about it. There were all kinds of signs that said you should be worried. And so I played for you what Jamie Dimon and Mohamed El-Erian said this year, but there have been many others who have been warning. Jeremy Grantham goes back to almost a couple of years now where he has been warning that we're headed into another super bubble and this whole thing is going to crash. I don't know what you do with that. Jim Rogers has said the same thing. Warren Buffett has said it. Ray Dalio, Stanley Druckenmiller, Russell Napier, Michael Burry, Scott Minerd. Many people David McElvaney, people I follow, have been warning about this, that this is coming, particularly in the last couple of years. And I've been warning on this. I showed a picture of Alan Greenspan and his quote. This goes back about a year and a half ago, and Greenspan called it correctly. He said, we are in a period of two bubbles at the same time. And he was absolutely correct. How true is he today? Absolutely correct. A bond bubble and a stock bubble. He was a little early. He called it a couple of years ago, but he called it correctly. And so those that have taken the attitude of, and still do take the attitude of, there's nothing to worry about, I don't know, that's hard for me to comprehend in the face of reality. Thank you for watching. If you have comments or questions, leave them in the comment section below. I will try to answer them. If you want to reach out to me and chat or have a conversation, there's my email address and my phone number. Thank you for watching.